America's 8 biggest banks just handed out $46.17 billion to shareholders in the first quarter of 2026. That's a 34% jump from last year. But here's the kicker. Many of these too-big-to-fail institutions also offloaded billions in private credit loans, shifting risk away from their balance sheets. Think back to 2008 and the subprime mortgage crisis. The parallels are eerie when you look at how packaged loans can become systemic risk. Remember Martin Gruenberg of the FDIC? He just spoke in January 2025 about lessons from past crises, specifically referencing the thrift and banking crisis of the 80s and 90s. We're seeing a similar playbook with private credit, where direct loans to businesses are bundled and sold off. So, what exactly did big banks like Bank of America do, and what does this mean for someone observing the market in 2026? We're going to break down the mechanics of these sales, the underlying assets, and the historical context so you can understand the true implications. You know, for decades, the phrase too big to fail has echoed through the halls of Washington and Wall Street. It's a concept that really gained traction back in 1984, when Congressman Stuart McKinney used it to describe financial institutions so massive their collapse would take the whole economy down with them. And looking at the numbers, it's easy to see why this idea persists. Just in the first quarter of 2026, America's 8 globally systemically important banks handed out a staggering $46.17 billion to shareholders through dividends and buybacks. That's a 34% jump from the year before. We're talking over $500 million a day distributed. It's a remarkable flow of capital, especially when we remember the financial crises of the past, like the thrift and banking crisis of the 80s and 90s, or the 2008 GFC, where the government ultimately stepped in to prevent a wider collapse. So, what exactly were these big banks selling that made them so integral, and in some cases, so precarious? We're diving deep into some fascinating recent shifts, specifically in the world of private credit. This isn't your grandma's bond market. We're talking direct loans to mid-market businesses by non-bank vehicles, a sector that's exploded, becoming one of the fastest-growing corners of finance. And guess who's been right in the thick of it, helping to fuel that growth? Yep, the big banks. The lesson here is that understanding where capital flows is crucial for anyone trying to build long-term wealth. And sometimes, the most significant shifts happen quietly, away from the headlines, in areas like private credit that sound complex but actually have huge implications for the broader economy. Today, we're pulling back the curtain on how these giants of finance navigated this evolving landscape and what it ultimately meant for their bottom lines and, by extension, the financial world we all operate in. We'll look at the strategies these banks employed, why private credit became such an attractive avenue, and what this means for someone in your situation trying to make sense of the market. The core idea behind too big to fail is that certain financial institutions are so massive and interconnected that their collapse would devastate the entire economy. This would then necessitate government intervention to prevent a systemic meltdown. Think of it like this. If one domino falls, it can knock over a whole line. But if that first domino is a skyscraper, the ripple effect is far more catastrophic. The phrase itself gained mainstream traction back in 1984, during a congressional hearing, when U.S. Congressman Stuart McKinney used it in reference to the FDIC's intervention with Continental Illinois National Bank and Trust. The idea isn't new, its roots stretch back to the Panic of 1907 and even the Great Depression. But the explicit use of the term during the Continental Illinois episode highlighted this implicit government safety net for certain institutions. The lesson here is that this perceived safety net can, ironically, encourage more risk-taking by these very banks, knowing they might be backstopped. FDIC Chairman Martin J. Gruenberg touched on this on January 14, 2025, in his speech at the Brookings Institution. He discussed lessons from past financial crises, including the thrift and banking crisis of the 1980s and early 1990s. During that period, the too big to fail principle was implicitly tested, showing how the government often felt compelled to step in to prevent wider economic contagion. This dynamic creates a fascinating, almost paradoxical situation where banks can offload billions in private credit loans, shifting risk, while simultaneously enjoying record shareholder returns. It makes you wonder about the true stability of the system when billions are flowing out. Alright, so we've established the too big to fail concept, right? This idea that some financial giants are so intertwined with our economy that their collapse would just, well, take us all down with them. And because of that, they often get a backstop from the government. But here's the interesting part. Even with that implicit safety net, these banks are still pushing enormous amounts of capital out the door to shareholders. Think about it. In just the first quarter of 2026 alone, America's 8 globally systemically important banks, as reported by Mayra Rodriguez Valladares on April 23 of that year, handed out a staggering $46.17 billion to shareholders through dividends and stock buybacks. Now, that's not a small number. That's a 34% surge over the previous year, which means over $500 million a day was flowing out of these too-big-to-fail institutions and into the pockets of investors. This kind of aggressive capital return has actually sparked some serious debate. For example, back on May 31, 2022, the Bank Policy Institute, specifically Francisco Covas and Jose Maria Tapia, raised questions about what these massive distributions might mean for bank stability. The concern is, if you're consistently returning such significant chunks of capital to shareholders, are you potentially diverting funds that could be used for, say, building up bigger capital buffers, investing in robust risk management systems, or even just long-term growth? The lesson here is, while banks are posting record profits and rewarding shareholders handsomely, there's an ongoing tension between maximizing those returns and ensuring the long-term stability that prevents another 2008 GFC scenario. And this isn't just an academic debate, it has real implications when you consider where banks are now shifting some of their risk exposure. Speaking of which, that brings us directly to the rise of private credit. Okay, so we're seeing these massive capital outflows from big banks, right? Billions being returned to shareholders. But here's where it gets interesting. Parallel to this, there's been an explosive growth in what's known as shadow banking, specifically private credit. Think of it as credit activity happening outside the traditional, regulated banking system, as defined by Jamie Brodsky and his colleagues at FBT Gibbons LLP in March 2026. According to a May 23, 2025 Fed's Notes article by Jose Berispaid, Fong Kai, Siddhartha Lewis-Hare, and Philip Sykes, private credit involves direct loans made to mid-market businesses, but not by big banks. Instead, these loans come from non-bank vehicles like private debt funds and business development companies, or BDCs. Kelly Richardson, in a February 2026 piece, highlighted private credit as debt financing primarily from non-bank lenders to privately held companies, often outperforming traditional credit segments. It's one of the fastest-growing segments in finance, signaling a fundamental shift in how capital is deployed. This growth has significant financial stability implications, a point explored by Berispaid, Kai, Lewis-Hare, and Sykes. As big banks offload risk and return capital, this vacuum is being filled by private credit providers. This means a substantial portion of the economy's lending is now occurring with less direct oversight from federal regulators like the FDIC. For someone looking at where the next big financial shifts might occur, understanding this expansion is crucial. Big banks can either participate in this market, originating loans, or buying into these funds, or they face increasingly stiff competition for those profitable mid-market borrowers. The lesson here is that financial innovation constantly reshapes the landscape, creating new avenues for capital but also new areas of potential risk. It's not just about traditional banks anymore, the entire ecosystem is evolving, even influencing areas like environmental sustainability. Okay, so we've got these huge capital outflows from big banks to shareholders, and at the same time, this explosion in private credit. But let's zoom out for a second and look at another critical consequence of these financial activities: their environmental impact. A recent investigation by Global Witness, for example, reveals something pretty shocking. They found that banks and asset managers generated a staggering $26 billion in income from financing companies actively driving deforestation since the Paris Agreement was signed in 2016. That's 8 years of what they call climate-wrecking profit. This income isn't coming from some obscure corner of finance. It's from direct investments, loans, and underwriting services provided to 50 specific companies identified as major deforesters. For instance, the report highlights that U.S. financial institutions alone made $5.4 billion of that income, with major players like Vanguard and JP Morgan Chase listed among the top beneficiaries. Think about the ethical implications here. On one hand, many of these same banks make public commitments to climate action, but on the other, they are actively profiting from industries directly contributing to global ecological damage. The long-term risks for these institutions are substantial, far beyond just reputational damage. We're talking about potential regulatory pressure, increased scrutiny from environmental groups, and even a shift in investor sentiment as climate risks become more financially tangible. The lesson here is that financial decisions, even those that seem purely economic, have profound real-world consequences, from shareholder returns to the health of our planet. And these consequences can often lead directly into larger economic disruptions, setting the stage for the kind of financial meltdowns we've seen in the past. Okay, so we've got these massive capital outflows from big banks to shareholders, and at the same time, this explosion in private credit. But let's zoom out for a second and look at another critical consequence of these financial activities: their environmental impact. A recent investigation by Global Witness, for example, reveals something pretty shocking. They found that banks and asset managers but what are the historical consequences of these kinds of complex financial entanglements? FDIC Chairman Martin J. Grunberg, speaking at the Brookings Institution on January 14, 2025, reflected on his involvement in three major financial crises, underscoring persistent vulnerabilities. He was active during the thrift and banking crisis of the 1980s and early 1990s, and of course, the 2008 global financial crisis, ignited when Lehman Brothers filed for bankruptcy on September 15, 2008. Think back to the Long-Term Capital Management, or LTCM, crisis of 1998. Founded in 1994 by John Meriwether, this hedge fund was an all-star team, including Nobel laureates Myron Scholes and Robert Merton. They used incredibly sophisticated models, but their bets went sideways. As it turned out, many major banks were deeply entangled with LTCM, holding billions in exposure to its complex derivatives. When LTCM faced collapse, the interconnectedness nearly brought down the entire system. The Federal Reserve, established back on December 23, 1913, had to step in and orchestrate a bailout to prevent a larger systemic meltdown. The lesson here is that even the smartest people with the most complex models can create systemic risk when their strategies fail. This interconnectedness is exactly what William C. Dudley, then president of the Federal Reserve Bank of New York, highlighted on November 6, 2017. He described the 2008 crisis as leading to 9 million jobs lost and 8 million housing foreclosures. The Fed's role, as we saw with both LTCM and the GFC, is critical for maintaining stability. What this means for someone looking at the financial landscape today is recognizing that while institutions grow and evolve, the potential for interconnected risk remains a constant, and the Fed continues to monitor and release data, as recently as June 5, 2026, on these very issues. So, what this all means for someone in your situation is that the financial system, with its massive, systemically important banks, is in a constant tug-of-war between profitability and public responsibility. We've seen banks like Bank of America distributing over $46 billion to shareholders in Q1 2026 alone, a 34% surge, while simultaneously operating under an implicit too-big-to-fail safety net. This creates a fascinating tension. How do we balance the essential role these institutions play in the global economy with the need for robust oversight, especially when capital flows into less regulated private credit and even contributes to environmental impacts, as seen with the $1.7 trillion linked to deforestation? What's your take on the too-big-to-fail concept? Do you think the benefits of large, stable banks outweigh the risks of potential bailouts, or do we need a more fundamental shift in how we regulate these financial giants? Let me know your thoughts in the comments below, and if you found this breakdown valuable, make sure to hit that subscribe button for more deep dives into how money really works. And if you're curious about what happens when these systems face extreme stress, you absolutely need to watch my breakdown of the 2008 global financial crisis next.